Lots of our parents had these very, very attractive pensions where they were effectively paid a proportion of their final salary for the rest of their lives. So we take on board those responsibilities and liabilities to pay those people's pensions for 40, 50, 60 years in the future. Ultimately, we are here to source assets which match those liabilities, and therefore we need assets that have that very, very long-term, predictable, robust index-linked income. We've had the spending review recently, and that was a fantastic shot in the arm for affordable housing. Equally, £39 billion, towards supporting affordable housing is absolutely fantastic. But private capital has got to sit alongside that government investment for us to get anywhere near 1.5 million homes. If I can't explain something to my mum over Sunday lunch, I either don't understand it well enough or it's too complicated. And actually having that kind of engagement with policyholders, they are super engaged in what we're doing, and it's great.
James, welcome to the podcast.
Thank you for having me.
Not at all. Real pleasure that you're here. So thank you so much for battling the London tube strikes to get into the studio. Look, you've had an amazing career, and I'm really keen to kind of unpack a little bit about your journey and your experience, and of course talk a little bit about PIC as well as your kind of views on the market. But before we get into some of that good stuff, can you just rewind the clock and tell me a little bit about how and why you got into real estate in the first place?
Yeah, so I mean, sort of after finishing uni, I sort of decided to join a bank for one reason or another. But so my kind of initial start in my professional career was around banking with Barclays and then with the Co-op Bank. So I had no real sort of aspiration to move to London. So I think that at that point, that was quite a nice move for me. But in terms of kind of real estate, that really started when I bought my first buy-to-let apartment in Manchester. And then thereafter, it very quickly became a real kind of interest to me, and therefore something that I wanted to pursue professionally.
And you did that with kind of like some bonus or some savings that you made in banking initially? And
yeah, a little bit of that, a little bit of saving, a little bit of bank of mum and dad. So yeah, that was definitely helpful. So I just think getting into that kind of residential market early just really sort of, set the tone for me, and it was clearly something that I wanted to be a part of. So the opportunity then came to join Singer and Friedlander, which was a sort of a small kind of pretty boutique sort of merchant bank that again had an office in Manchester, and they were doing lending to SME and sort of small developers typically, but they also had a really interesting part of the business that was lending money to sort of operational real estate as we now know it. So this was really in the form of student accommodation, and a company called Opal, which sort of some people may remember, had a big sort of first mover advantage and was quite a large player in that market, particularly in the regions at that point in time. And having not long left university, I kind of looked at that and thought, these operational real estate asset classes were just really, really interesting.
so you did a couple of years on the lending side.
Mm-hmm.
Talk to me about a couple of those deals that you did.
So in lots of ways that they were particularly glamorous. We were lending to people who were building sort of 4 or 5 houses in Huddersfield, for example, or we had a specific client who had a real specialization for barn conversions in sort of Shropshire and places like that. We then did some slightly more interesting stuff in the Manchester office, which was kind of some of the first generation of the large apartment schemes that now kind of, sort of dot the city. So again, that was a really good entry for me into understanding development finance and then sort of rolling into investment finance. That was my sort of real first foray into real estate, sort of investing and lending, really.
And I guess 2007, 2008, back end of the kind of the good times ahead of the crash.
Yeah. So Singer and Friedlander was acquired by Kaupthing, which again some people may remember as this sort of large Icelandic bank, which had quite a lot of sort of mystique and excitement about it at the time. And these guys had a really big reputation for doing some huge transactions. They were involved in Middlesex Hospital and Chelsea Barracks with Nick and Christian Candy. They were involved in the initial site assembly for what became the Shard. So, this was a real opportunity to hopefully get involved in some of these sort of really big, interesting transactions. obviously 2008 came, and it was, to quote an Alex Fergusonism, it was sort of squeaky bum time. And when you've got a head of banking walking around with a notebook writing down what your drawdown requirements are going to be for the next month, I think we could all sort of see the writing on the wall, really. So the Camp thing was sort of put into administration, amazingly, on the day that I bought my flat in Didsbury with my now wife. And whilst I was asked to sort of stay on and work through some of the assets that we'd been lending against, at sort of 28, the prospect of a decent payoff and a few months off was pretty enticing.
So you took a few months off, and then you landed at Braemar Group, and you kind of moved away from kind of the credit side, if I'm not mistaken.
Yeah, so Braemar Group was a small investment management business that was set up really to play to a specific piece of tax legislation. So this was around converting derelict space above retail. And if you did that, there was a quite attractive tax break available if you were a sort of a high net worth sort of income tax paying individual. So we did quite a bit of that. And really, when you look back on it now, this was the sort of the first iteration of what would ultimately become BTR. I mean, we definitely didn't call it that. I don't think we even called it PRS, but it was that sort of, more institutional investment into residential and managing it at scale. And that's really what was attractive to us as a business.
And in terms of your role, were you, originating these sites? What, developing them? What were you doing specifically within that?
Yes, so you had to find them, and a lot of these things were sort of department stores from around the country. So we were definitely kind of sourcing and originating those. Specifically, we had to go back through land registry and actually demonstrate that these buildings were previously used as residential, so that you could get the sort of conversion back allowance. We would then go through the process of converting them and then letting them, and then you had to hold them for a predetermined period in line with the sort of the tax guidance.
And then you'd get the high net worths who'd have the tax break to kind of fund them effectively.
Correct, absolutely.
And so were you responsible for kind of capital raising as well as deal origination, or was that
not
just
really?
Structure?
Yeah, no, we had a kind of a distribution team who were much more kind of familiar with doing that I was certainly at that point kind of in my career. But the Braemar business quite quickly evolved, and we started launching sort of Guernsey-based open-ended investment vehicles. So the first one invested in student accommodation. The second one invested in farmland. So again, given my kind of singer's background and this sort of exposure that I'd have to operational real estate, going and working for a business that had that student accommodation ambition and structure to be able to invest was really attractive.
Before we kind of take the journey on, if you cast your mind back, what kind of kid were you growing up?
I was pretty sporty. I played a lot of sport. I played sort of squash and tennis to a pretty decent level. So racket sports are definitely my thing.
Paddle?
So I actually tore my rotator cuff about 18 months ago. So that is incredibly painful. So I've been playing quite a lot of paddle to get back into playing tennis. But yeah, I'm just a tennis player standing in a Perspex box. But yeah, paddle's great.
And academically?
I was a pretty solid sort of BC student. I was not sort of super bright. I never felt like there was a great deal at stake at school. It was only really when I got into the working environment and there was kind of reward at the end of it that kind of really drove and motivated me. And that's, I think, where I got a lot of my ambition from.
And why did you want to go into banking initially?
Banking was cool at that point, wasn't it?
Financial return?
Yeah, I think so. I think the, banking was cool, and the sort of the culture that sort of went with that at that point, in the market cycle was attractive. And I think, that definitely appealed to me.
And real estate, did you have any kind of family connections or route, or was it literally just buy to let? Passive income, like the process, like the concept of a living, breathing, tangible asset with people inside of it. And, if you could see, if you accumulated or invested and acquired further, you would kind of build up that income stream, and you'd be able to kind of build a portfolio.
Yeah, I think so. I think, so to answer your question, like no family background in sort of property at all. Interestingly, like 2 or 3 of my cousins are sort of dotted around the industry. And so one of my cousins actually runs Teesworks, which is this huge development project on the banks of the River Tees, which is, seen huge inward investment going in there. So there's a few of us now kind of dotted around in our family, but no sort of background in the industry at all. But yeah, I think really it was it was seeing and understanding and getting that really good grounding at Singer and Friedlander, moving through the Kaupthing opportunity, and then seeing the more sort of specialist investment management piece that happened at Braemar before we then ultimately, joined Brooks Macdonald.
Tell me about that move to Brooks Macdonald. What were you involved with, and at what stage also did you kind of go, actually, this kind of real estate world is definitely the kind of the area that I kind of want to build my career in?
So when we went to Brooks, there were already sort of issues really with redemptions around the open-ended structures that we'd put in place. I always remember somebody describing open-ended fund structures to me as it's like sitting in the bath with the taps on and the plug out. And if the water turns off and the plug hole gets bigger, you get pretty cold pretty quickly. And so I think that this sort of the scale that Brooks Macdonald and the opportunity that Brooks Macdonald gave us meant that we could go out and really play in a very different market. It wasn't this sort of, IFA, high net worth individuals that we were very much focused on at Braemar. It was much more small institutions and wealth managers. So we really had to look at a different sort of vehicle and structure, and the Finance Act had just changed the REIT regime. So that was the point at which we made the decision that we were going to take one of the asset classes from the Guernsey open-ended structure, which was ground rents, and we were going to really apply that to the REIT regime and go off and launch a vehicle in that regard. Because
of the tax benefits and just the efficiencies that you could get if it was a REIT rather than an open-ended vehicle? Yeah, part of that. I think that, just closed-ended structures were more attractive to investment managers. Clearly, there were some tax benefits, and there are some, pretty sort of stringent REIT regime, etc. So yeah, I think that we felt that was an investable product, and it would give us a differentiation against some of the other sort of investment funds and vehicles that were out there in the market. For someone listening to this who doesn't know what a ground rent is, can you just explain that? So a ground rent is a typically small amount of money that is paid every year in respect of your leasehold interest. So there's a range of lease durations, but the ones that we were focused on were over 100 years, relatively small amounts of money each year. They were index linked. And so the investment thesis for the vehicle was long dated, predictable, robust index linked income. Really simple, really straightforward. And was that your first kind of foray into long dated or kind of core long-term income? Yeah, I mean, I think the stuff that we'd done previously in sort of PBSA and farmland was clearly, in that kind of world as well. Everything had this sort of alternatives feel, if you like. Braemar and Brooks Macdonald really were never going to be able to compete with the sort of the big names in our industry. And so really it was about finding something that was more specialist or a bit of a niche to kind of look at. And so I think, ground rents was definitely that. So we actually used the old Singer and Friedlander capital markets team. So Jonathan Murphy and I, who is now the CEO of Insurer, went out and did the roadshow for Ground Rents Income Fund, imaginatively titled. And we did the IPO at about 50 million quid. And we were supported by people like Chris Hills at Investec and Casper Rock, who's was at AXA at the time. And so it was really great to get that away. And it was a really kind of important moment in my career. I remember Simon Woonwell, who was my boss at the time, saying, "You'll never really appreciate what an achievement this is until you kind of look back on it in future years." Because? Just a difficult market at the time. And I think trying to do something that was new and different and that you really had to take people on an educational journey with in terms of the investor base. But yeah, it had all of the characteristics that people were looking for. Would it be fair to say around that kind of time, the residential or the operational real estate market was becoming just a little bit more institutional, or a bit too early to badge that wrapper to it? Yeah, I think it was probably a bit early at that point. I mean, this was 2012. And I think that, people had started to think about, residential in a bit more detail. But it wasn't until a few years later that really, the likes of M&G and others sort of started doing their sort of first transactions in the space. And then after that, you had this real kind of, snowballing effect, and residential sort of just grew and grew and grew exponentially into what we see it as today. I mean, it's amazing that we used to refer to these asset classes as alternatives. And actually, when you look at it now, I mean, BTR, PBSA just account for such a big chunk of transactional volumes across the market. In terms of your skill set that you're accumulating, just just talk to me about that. Was it always kind of origination focused, numbers, sourcing, and did that kind of come naturally to you as well?
Yeah, I mean, I think definitely sort of the sourcing of assets and sort of delivering transactions has always been something that I've really enjoyed as part of my role, and probably the thing that I've been best at. And kind of building those long-term relationships with people. I'm sure we'll come on to talk about it, but things like the Habico JV that we've done at PIC. I've been doing deals with Phil Mail and the team at Muse for kind of a very long time, and the number of people in this industry that kind of come back around is really good. And actually, if you've got some history with those people, that's always helpful.
Go on the journey. Yeah, I think for people who are earlier on in the journey, don't burn your relationships.
Yeah, very much so. No, never burn any bridges. And actually, our industry is pretty small. So be mindful of that, and always kind of maintain your reputation and your position.
You were with Brooks Macdonald for nearly 8 years. You kind of rose from kind of investment director to kind of head of specialist funds. So talk to me about a couple of the other projects and things you were involved with during that time.
So within Brooks Macdonald, we owned a property management business that was called Braemar Estates. So the ground rents REIT really allowed us to get pretty spectacular kind of operational gearing on that business. So when we would buy assets, we would effectively instruct our in-house business to be the sort of the operational asset manager. So that business grew from being a pretty small kind of South Manchester based, residential managing agent with, sort of £100 million worth of assets under management to sort of over £1 billion of assets under management, and managing some really sort of large, high profile assets. The vehicle acquired some really interesting assets. We bought a portfolio from Muse again, which had, things like Wapping Wharf in it, Brentford Locks. We bought some assets in Birmingham, Mass House. And then we bought some other assets that didn't turn out to be quite so good. So thanks to our friends at Carillion, the Beetham Tower was a really interesting project, but I think that's a whole different kind of podcast in itself.
During the time of Brooks Macdonald, there's, if I remember correctly, quite a lot of noise about Leasehold Reform Act. What were your recollections on that time?
Yeah, I mean, so sort of 2014, 15, there started to be some quite serious press coverage about leasehold reform and not least sort of 10-year doubling ground rents. So the kind of momentum behind this started to build and build. And the reality is that we just didn't own any of these assets. So we started to get questions from understandably from investors about it. And we were very clear about what we owned and what we didn't, and that this was really something that we were just being caught up in because of the kind of the wider industry. We very quickly made the decision that we were going to offer anybody with a doubling ground rent of any kind, 20, 25 years, the opportunity to convert to an index-linked ground rent. And I think that was a really sort of clear message that we were one of the sort of the good guys in the sector, and we wanted to be perceived in that way. I always remember Malcolm Nash saying to me that, sometimes the right thing to do is just the right thing to do. Incredibly, though, the take-up of it was quite poor. And people were just not really interested in sort of converting their leaseholds from 20 to 25-year doubling or whatever it is into RPI. And so really we were sort of a little bit hamstrung in that regard, because you can't force people to change their lease terms. Because
they just didn't understand it, or they just kicked the can and just
I think partially that. I think there's a little bit of kicking the can down the road as well. But I think that the reality is that people were just not engaged in the process and didn't understand it sufficiently.
So you were there for kind of coming up to 8 years. What was the kind of the kicker in the decision to kind of move away from Brooks Macdonald, and then what did you go on to do?
So, I mean, Brooks was changing. We had tried to launch a long income REIT to follow on from Griff as well. Unfortunately, we walked directly into Brexit. So we had some really strong appetite for a kind of a high credit quality long income REIT. But unfortunately, the issues around Brexit meant that we didn't get that off the ground. Brooks was changing at that point. We had a new chief exec. And so I felt the time was right for me to really look at other opportunities and really try and get into some of these other asset classes. I think we could see the writing on the wall for residential ground rents, and the fact that institutional investment into that sector was going to be very, very difficult going forward.
So if I'm not mistaken, you moved to Schroders as head of residential?
Yeah. So that came about principally for a couple of reasons, really. One, because Schroders, or part of Schroders, were an investor in the ground rents fund. And secondly, Duncan Owen, who was the head of global real estate at that point in time, was Malcolm Nashua's grad many, many moons ago. So I think that was quite a nice sort of full circle moment for both of them. And then for Schroders, I think the opportunity to take on board a team with a lot of residential background and skill set, but also open an office regionally in Manchester was really attractive.
You were there for kind of 2.5, 3 years or what have you, and then landed at PIC, Pension Insurance Corporation, where you're currently head of Real Estate Origination. You landed there as head of long income. Talk to me about that kind of move. And yeah, for people who haven't come across PIC before, can you just set a bit of context in terms of who they are as a business, the platform?
Yeah, so PIC are an insurance company, effectively. But I sort of describe them to friends and family as one of the biggest insurance companies you've never heard of. So we don't insure your car, we don't insure your home, and we don't run your SIP like lots of our contemporaries. So that's really the kind of the background on PIC. All we do is we insure defined benefit pension schemes.
And for someone listening to this who doesn't know what defined benefit pension scheme is?
So lots of our parents had these very, very attractive pensions where they were effectively paid a proportion of their final salary for the rest of their lives. So a number of people in my family have been very fortunate to sort of have those. So we effectively take on board those responsibilities and liabilities to pay those people's pensions for 40, 50, 60 years in the future. So what does PIC do as a business? Ultimately, we are here to source assets which match those liabilities, and therefore we need assets that have that very, very long-term, predictable, robust index-linked income.
To be able to match the liabilities and to be able to pay the people out there 60, 70, 80, 100 grand, whatever it is that they've been promised for the rest of their life once they've retired.
Yeah, absolutely right. I mean, we pay out about £2 billion to policyholders each year. We've got about 400,000 policyholders, so it's big numbers.
And it's like 50 billion under management, if I'm not mistaken.
Yeah, just under 50 billion, I think, at the last turn. So the business has grown pretty dramatically over the past few years. The buyout market is very buoyant, and a lot of that is as a product of interest rates. So if you were the trustee of a scheme previously, when interest rates were very low and sort of close to zero, potentially you had quite a large pension deficit. With interest rates starting with a 5, that deficit is much, much smaller. And so therefore what you are seeing is schemes that we never really thought would come to market, which are 10, 15, even 20 billion pounds potentially coming to buyout at some point over the next sort of 3 to 5 years. So the market, because the liability is so much smaller, and if you're the FD of that trading business, actually these are liabilities that you'd like to get rid of. They are hard liabilities as part of the Pensions Act. So it's not best endeavours as it was pre sort of Pensions Act 2004. These are actual hard liabilities that you hold on your balance sheet.
So they want to get rid of those obligations.
Correct.
And so the idea is if they can kind of pull that in a much bigger platform that's got the bigger resources, they get the economies of scale in terms of the back office, but also the collective leverage of being able to purchase bigger, better assets and offload their liability and pass it on to your good selves to manage it.
Yeah, absolutely. But I think also, making sure that the policyholders and the members of those schemes are appropriately looked after. I mean, customer service is a huge part of what we do. It's a very significant focus when we are winning business through the front door of 22 Ropemaker. So, that kind of focus on the policyholder is absolutely paramount, as is the way in which we invest, and particularly thinking about sort of impact investing and the way in which we deliver social value.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So in terms of PIC itself, It's got to find assets that are inflation linked, liability linked, to be able to kind of meet the obligations of the pension holders who have this kind of bond or this promise that their final salary pension will be paid out. How is the assets under management divided across real estate, fixed income, equities, kind of wider portfolio makeup, and then where does real estate kind of fit within that pie chart?
So real estate is a pretty small proportion of what we do in terms of a percentage of the balance sheet, but it's certainly growing. And PIC Capital, which was sort of established just before I joined, sort of four years ago, has really been the team and the vehicle through which we've done that. So we've invested in a number of asset classes so far. So build to rent being the largest. So we've got sort of 4 build to rent schemes in various stages of either construction or operations. So we've got 2 operational schemes. One is New Victoria and Manchester, which we did with the Muse team. And the second is a scheme called Arbor, which is in Milton Keynes. So that's a part of the market that we really like, where you've got very strong supply and demand dynamics that are in our favour. And again, we're able to generate these cash flows to pay the pensions of our policyholders. So that's a market that we really like, that we're going to continue to invest in. And I think that market is really starting to evolve now, and particularly around what we call suburban BTR. So this is single family housing, more suburban, much more straightforward construction, faster to develop, faster for us to get from sort of financial close to actual cash flows being generated because of the way in which you do that. So that's a market that we're really keen on, and we've made some quite good progress with a development partner.
So that's single family housing and BTR part of the business. Talk to me about the other parts.
So affordable housing is the other big asset class that we're invested in. So PIC has been supporting and lending to housing associations for a long time. So we know that market really, really well. So it was a very obvious step for us to sort of move into doing equity deals in that market. Last year, we spent a lot of time working with Homes England and Muse to launch the joint venture called Habico, not Habico, as people like to refer to it, Habico. And really, that is about delivering absolutely best-in-class assets to the affordable housing sector. So these are going to be low-carbon, low-energy homes, and the aspiration is that we're going to deliver about £1 billion in value and about 3,000 units over the next decade.
And is that taking out Section 106 agreements, or?
It's not. So the joint venture itself will actually take planning and construction stroke delivery risk, and then PIC effectively has an option to buy all of the assets from the vehicle thereafter. So the intention is that they're actually going to be 100% affordable schemes, so they won't be part of Section 106. So a lot of the work that we're doing at the moment is really about engaging with the local authorities where we have opportunities in pipeline, because amazingly, schemes that are 100% affordable actually fall outside of the planning guidelines of each of those local authorities. I think quite quickly we'll get to the point where they'll get comfortable with that, but that's certainly something that we need to think about. So we've made really good progress with that since it was sort of completed at the back end of last year. We've approved our first sort of 3 or 4 transactions. So we've got some very significant deals coming forward around the country to deliver these, as I say, low carbon, low energy assets. And what we're hoping is that there are a number of sort of quite large projects around the country that are really struggling for viability at the moment. But if we can use Habico as a sort of a catalyst to get some of these schemes kind of off the ground and deliver something tangible in the short term, we're hoping that there's an agglomeration effect thereafter, and then the other elements of those schemes will sort of all start to work a little bit better around it.
How are you able to make the kind of the financial stack with pure play affordable housing? Because it's 20%, if I'm not mistaken, 20% true market rent is cheaper, right? So how do you get it to stack with all the kind of build cost inflation, labor, and kind of staffing challenges, construction, debt, price? How do you kind of make it stack?
And equally, what we're building is much, much better than anything else that exists in the market, and that comes at a price. So I think from our point of view, working with partners and having some pretty decent partners in Muse and Homes England who sit in that equity seat with us in the JV, it's really about engaging with them, engaging with the sort of the 2 very different parts and very separate parts of Homes England to try and deliver viability on these projects. I think once you have really clear transparency about what the cost of development is, and you weigh that against the very clear ambitions that government have around delivering 1.5 million homes, there is a a clear rationale for these kinds of assets being delivered. We've had the spending review recently, and that was a fantastic shot in the arm for affordable housing. To have that 10-year rent settlement has given all of the investors in the sector a lot of comfort. Equally, £39 billion towards supporting affordable housing is absolutely fantastic. But private capital has got to sit alongside that government investment for us to get anywhere near 1.5 million homes. And so that's really what this vehicle is designed to do.
How do you square the circle with certainty? Is that because of the 39 billion that the government has committed to it? Is that part of the way that gives private capital some certainty or an ability to have confidence that they'll get an exit?
I mean, there's very few things that are certain in this world, but I think that the nature of what we're developing, with a focus on social rather than affordable rent as well, we think is a factor. But also, there are going to need to be enhanced levels of grant funding to make these things stack up and to make them work. But I think we believe that what we're doing can be supported by Homes England. We can clearly show and demonstrate that there is a value for money play here, and then actually the Exchequer is getting what it needs to out of this project.
So you're effectively forward funding these deals?
Yes. So we will forward fund the construction, and we will sort of create, within the structure, we create a piece of debt which matches our liabilities. And then we also use another part of our balance sheet to put some equity into those transactions as well. And then grant funding effectively makes up the shortfall.
So that tops it up. And then you'll develop or realise, fully lease them up, stabilise it, and then recap it into an opco or a holdco that will kind of be responsible for the asset management or ongoing management of that, or look to dispose of it?
So we're a very long-term holder of assets. So the intention is that we would hold these for the duration. We are in the process of setting up our own for-profit registered provider. So, in the same way that others in the market have done that, we think that's the right move for us. It allows us to access grant funding. It allows us access to invest in the affordable housing sector at kind of various different entry points. So that's really important as we go forward.
So you've got the single family, BTR, and then the affordable. Talk to me about the other part of the business.
So there's a couple of other interesting things we've done. We've done a senior living joint venture with Octopus, which has invested in a number of projects. That's not a long-term sort of hold for us. That's slightly more of an IRR play. So we've invested in some really high-quality retirement communities. We think that's a really interesting part of the market, but it's not something that at this point we're going to hold for the very long term. We do think there's a wider opportunity in that sector, whether that's a sort of a BTR operation in that sort of senior living space. But yeah, again, we think that's something that we wanted to get involved with and learn and understand more about, perhaps before we made subsequent further investments.
And so real estate as an allocation of PIC's overall balance sheet, what kind of percentage does it make up?
Sub 10%.
Sub 10% with a view to go 12, 13% or TBC?
Yeah, I mean, I don't think we really have a view. I mean, PIC is a relative value investor, and that's one of the real challenges that we have at this point in time. So if we sit in investment committee or we sit and talk to the CIO or the CFO, it's quite difficult at this point in time to justify buying a BTR building in Liverpool, Newcastle, Birmingham, Bristol, wherever it may be, or an affordable housing scheme in, Bermondsey, Bradford, Newcastle, whatever it looks like, when you can buy a 30-year gilt at 5.7%.
Yeah, so it's not like you've got capital allocated to particular sectors and you've got weightings that you need to oblige by. It's just a relative value investor. And so I guess everyone brings their deals at the investment committee and they go, what's the best relative return based on the returns that we need for our policyholders and wider corporate objectives, rather than kind of exposure from a risk perspective to asset classes?
Yeah, I think that's right to an extent. I mean, clearly there's a diversification argument. Clearly, social value and ESG are very high up our agenda, but also that of our policyholders and future trustees as well. So, real tangible assets are really important. If I think about some of the other deals that we've done, so we did a very large project with Peel at Wirral Waters, which is called Miller's Quay. So this is a really interesting transaction. It's an income strip deal with the local authority, and this is for about 500 apartments in a sort of very, very large kind of regeneration project. And actually, when we got to various points within the construction, sort of topping out and then ultimately PC, we actually get policyholders to come along to these events, and they meet the local dignitary with the big scissors, sort of cutting the ribbon kind of idea. And, they get to look around and touch and see and feel these assets that their money is invested in. And it's really, really powerful. Equally, we have various events throughout the year where policyholders get together, and I've been lucky enough to go to some of those, and I sit on the table where I've got a lady next to me who worked for Philips for 50 years, and somebody on the other side of me who worked for someone else for 30 years, and they are really interested.
I bet they are.
And they are super engaged in what you're doing. Tell me what you do and why you do it, and actually, there's a few kind of rules that I've had. If I can't explain something to my mum over Sunday lunch, I either don't understand it well enough or it's too complicated. And actually, again, having that kind of engagement with policyholders, we're not financially minded people, certainly from a real estate point of view, but they are super engaged in what we're doing, and it's great.
Yeah, I bet, there's obviously been a lot of pension scandals previously. They want to know how and where and what you're doing to kind of drive return and give them confidence that they're going to get their 50, 60, 100 grand, whatever it is, every single year, and want to see the product and see the team that is delivering it. So with new, I guess, pension holders coming in and, the growth of, or kind of FDs looking to offset their liability, is there deployment pressure that comes, in terms of your role or the business, in terms of kind of allocating capital to kind of keep up with the wider demands of a growing base of pension holders?
Yeah, I mean, we definitely need to source assets to match liabilities, and I think that we're increasingly doing that in a number of different ways. Real estate has and will hopefully provide, a growing number and quantum of assets to the business. But I think it's about being really selective. The markets that we're invested in, we've taken a lot of time to sort of specifically identify those, to identify assets within them, and to make sure that we're genuinely buying kind of the best assets that are out there. I think if I look at our BTR sort of strategy, for example, we made the decision pretty early on that we would only really acquire assets going forward that had dual stair core. And so that has meant that the market for us is pretty small, certainly at this point in time. And equally, if we want to buy standing assets that have dual stair core, the market's even smaller. But I think that was the right thing for us to do. And I think that will stand us in good stead going forward.
You touched on earlier in our conversation, kind of the impact, social value piece in terms of the assets that you will acquire, but also the importance of that to kind of policyholders. Which one is the kind of the overarching driver? Is it kind of PIC, or is it the policyholders, or is it just a perfect match? And that's the kind of the PIC, or one of the PIC's kind of USP or value propositions, and it attracts the kind of the policyholders who are intrigued and interested and want to be represented by an organisation like that.
I mean, trustees and policyholders are definitely interested in social value and the way in which you invest their money. I think increasingly so, and I think that trend is definitely going to continue. I think as a result of which the business has had to align itself to that kind of value set. So I think we definitely see more of that. I mean, ESG has been a real force in our market for the last sort of 5 to 7 years, and I think the way in which we've seen that change and evolve has been pretty dramatic. We actually spent quite a bit of time when we first established PIC Capital to put in place a rating methodology, an ESG sort of impact investing rating methodology system that we did with Borough Happold. And so that was a very significant piece of work to make sure that the assets we were buying, we could demonstrate, fulfilled these kind of ESG and impact obligations that we wanted to, or standards that we wanted to hold ourselves to. And the real challenge is keeping things ESG sort of A, if you like, developing them in the first instance if you're very, very clear about what you want to do, viability aside, of course, which is always a challenge. But actually keeping things best in class is really the challenge for us going forward.
Sounds like you've got a really flexible balance sheet, mandate, debt, equity. When you kind of work with partners externally, what do you kind of look for?
I mean, as a pension insurer, we take the lowest risk of any of the investors out there. So in terms of partnerships, which are really important for us, it's about people who've done it before, done it successfully before, and equally, have a reasonable scale and sort of balance sheet. That's something that we're really focused on. PIC is becoming increasingly well known as a real estate investor. The reality is that we're not really a real estate investor. We're a credit investor. And so it's all about having really, really strong counterparties, because our liabilities are so long, and so therefore our assets are so long. And we need to make sure that the people who we are partnering with have that kind of strength over that duration.
In terms of the kind of the real estate piece, it's obviously been very living focused in terms of the kind of the capital that you deployed into the market. Are you averse to other sectors? I'm assuming not, given, as long as they can provide a credit worthiness kind of ticket, you would look at other sectors if they hit your other kind of investment criteria?
I think we would. I think going forward, increasingly, we will have to. I think it's quite difficult in certain other asset classes. Industrial has had a huge success over the past sort of decade, hasn't it? But actually, if I look at that market, there are very, very few people in that sector, even in these kind of million square foot kind of mega sheds kind of idea, who would have the requisite credit quality for us. So that's a challenge. But I think increasingly we are going to have to look at other ways in which we are able to source assets, other sectors, perhaps even other geographies as well, because this market that we have is just growing so quickly, and the sort of the winning of new pension fund mandates through the front door is increasingly strong.
How clever do you need to be, or how flexible when it comes to kind of financial engineering? And do you put a lot of emphasis in terms of the financial engineering and kind of the product makeup in terms of how you access real estate?
I mean, real estate's a relatively straightforward, simple asset class. But I think, there are definitely some very, very bright people who work for us and work for others in the industry. So I think structuring is increasingly important. Sort of the matching adjustment, or the MA as we refer to it, is really important, and structuring things for them to be MA eligible. So allowing us to match liabilities to it is really, really key. The pension reform that's going on at the moment, again, as I'm sure you would expect me to say, is really important. And the idea is that the reform that we should see as part of that work should allow us to invest in a wider range of assets and a wider range of counterparties.
I saw recently Tracy Blackwell, PIC CEO, talk about there being 600 million pounds worth of assets. 600 billion, sorry, not million. 600 billion of assets move from kind of asset management firms to insurance businesses, with a kind of a third of that earmarked for private assets and real estate. What's your take on that statement? Fact, what's your view?
Yeah, I mean, it's mind-boggling numbers, isn't it, really? But I think if you see a lot of the transactional market activity that's going on at this point in time, it is effectively DB schemes de-risking, coming out of illiquid assets that they can't transfer to insurers, and therefore putting themselves in a position where they can come to the insurance market with a very clean portfolio that is predominantly cash gilts and high credit corporate bonds, to facilitate the best sort of buyout price that they can. From our point of view, we will have this enduring challenge of sourcing eligible assets that fit within our investment criteria and, importantly, our regulatory framework in order to match those liabilities. And that's going to be a continuing challenge.
Will that mean that you have to look outside of the UK to be able to deploy that capital?
Potentially. But I think that at this point in time, we have all of our liabilities are sort of sterling denominated. So I think that moving substantially into international assets from a real estate point of view is probably unlikely in the short term. But I think, again, if we were to find partners, opportunities that we felt were attractive, I think that's something that we will increasingly have to consider.
And I'm assuming as well, you'll just have to write bigger checks too.
Yeah, I mean, part of this is also about trying to play in parts of the market where there is very little competitive tension. We have a great position in that we are able to do very, very large transactions. Well, you're in pretty rarefied air when you get into deals over 100 million, and that air is even more rarefied over 500. So if we can play in these kind of spaces in the market that allow us to generate better value for policyholders and shareholders, then that's absolutely what we should be doing.
There's been quite a lot of, well, there's been some changes in kind of real estate, infrastructure getting a little bit closer, infrastructure capital, typically lower cost of capital, longer term, longer dated, merging with real estate. Does that kind of ring true with what you're seeing and some of the deals that come across your desk?
Yeah, I mean, I think you're absolutely right. The lines between real estate and infrastructure are really blurring. Previously we had a team within PIC who was very focused on sort of delivering student accommodation projects in this sort of project finance mentality. Increasingly now they are looking at sort of income strips or other sort of instruments to allow them to fund these projects. But I think that from our point of view, we just see these as cash flows, and quite where they sit within PIC, I think we're pretty agnostic about. But infrastructure is something that we're really focused on and have been for some time. I mean, we funded the first reservoir to be built in the UK in 30 years. Equally, there's been a recent transaction in relation to a water viaduct, which is going to feed the Northwest. So thank you to PIC for that as well. So that's another sort of very, very significant sort of infrastructure project. So yeah, the lines are absolutely blurring between these two sectors.
So as you look across the market right now, what's your take?
It's really challenging. It's really difficult to make things work. If I think about the forward funding opportunities that we're looking at, they are tricky. We come back to this point about counterparties and partners being of a requisite credit quality. We want to make sure, particularly, that construction companies that we work with are of suitable standing, and so getting those very large contractors to engage in projects is a challenge. Making things stack up is a challenge. This viability word that is constantly talked about is really difficult in a context where credit spreads are as tight as they have been in a very, very long time. And this relative value piece means that actually, there is, from a real estate angle, you've got to work very, very hard to make things stack up at this point. So not impossible. I think it's easier in certain sectors than others, but challenging.
Having to work really, really hard to find the deals that hit the criteria or are worth doing.
I think we're starting to get to a point now where there is you had this massive disconnect between vendors' expectations and the price a buyer was willing to pay. And as a buyer, we've got to be highly cognizant of that all the time. Your entry point is so important. But I think that there is becoming a more realistic stance, shall we say, taken by owners of existing assets, and particularly forward funders as well.
As you look forward, what are you most excited about as you cast your mind further ahead?
I think building the portfolio, building the team, and really kind of, looking to develop a portfolio of significant scale, particularly in these living sectors. We've got a really high conviction that affordable housing and BTR in kind of all its guises are here to stay. They really work for us in terms of matching those liabilities. As the assets grow, as the rents grow, we're able to tap the debt and sort of increase the sort of the weighting we have to MA versus equity, which is really important and was a key part of the investment thesis. So, delivering that strategy that we've put in place is really important. And something that I'm really excited to do.
As we draw to a close, James, the question I ask everyone on the podcast is, if I gave you 500 million, who are the people, what property, and which place would you look to allocate that capital?
Well, I don't think it'll come as any surprise to you that I'll stick to my knitting and stick with the living sectors. So, I think I would do 100 million into the sort of the very prime, highly amenitized BTR that we've been investing in for the past few years. I think that's a really good opportunity for us. I equally think there's a really good opportunity in a more mid-market product, which does not have the kind of level of amenity that we've seen over the past sort of 5 to 7 years in BTR, and really just well-designed, efficient places for people to live. So I'll do 100 million in that as well. I'll do 100 million in single family housing. So I think, again, we really believe in that as a sector. So that's 300 million. And then I would do 200 million pounds in affordable housing. I just think that the risk-adjusted returns on offer in that sector are really, really attractive. You've got strong government support. Homes England, who are, have made some really strong appointments in the past sort of 6 months as well, not least Simon Century as CIO. So I think we're excited about that. And I'd have a pretty strong slant on social rent within that affordable housing portfolio.
And if you couldn't have any of those sectors, would you look further afield at healthcare or universities or broader infrastructure linked type of assets? And if so,
definitely.
If so, what type of assets?
So we've done a lot of university-backed student accommodation over the past decade within PIC. I think, again, moving and sort of crossing over into doing equity deals in PBSA is something that we will consider going forward. Healthcare, again, another really interesting one. Obviously, you've had the recent takeover of Insurer. We think those cash flows are really, really interesting. So again, it all comes back to this idea of long-dated, predictable, index-linked cash flows to pay the pensions of our policyholders.
James, thank you so much for coming in and being so generous with your thoughts, insights, views and opinions. I've really enjoyed speaking with you, and I'm excited to see what you and the team go on to do through 2025 and beyond.
Thanks a lot.
Hey, quick one from me. If you enjoyed this conversation, do me a favour and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.